Jo's made a very good point. You've got the opportunity to amend your constitutions now. And I think you really do need to take that opportunity up, and I think you need to give some thought to what you want to do. One thing, and Jo made the point, they're not preference shares, they're not debt instruments, they're not convertible notes, they're not a whole series of things. What they are MCIs. You've got a clean slate for design here. Greg made the point in his presentation that there might be a spectrum upon which these type of instruments will be structured, what they'll look like. They're fundamentally a share, and there was a lot of discussion with Treasury about whether they should be a share, whether they should be called something else, given sensitivity in the industry, given sensitivity to what members might think about it, or existing members. But you do have a clean slate to design what this share should look like. You shouldn't limit yourself to thinking this should look like a preference share or it should look like an ordinary share. The voting requirement of one vote per member as opposed to one vote per instrument is going to change it from looking like an ordinary instrument anyway. But I think people should be prepared to try and look at these things a little differently. One area where I think they probably will arguably start to look a little bit more common might be in the sense of the ADIs, as Jo talked about. That's a logical place to have an instrument where the institutional market, arguably the retail market, and the mutual ADIs themselves could have an instrument that satisfies APRA, the market's aware of it, and actually fits in also with some of the views from ASIC around having replicable disclosure, replicable terms so people can understand them. So I think that is an area where they might be similar. But as you go into the broader realm of what mutuals might want to do, they could potentially be quite different. And at the same time as you're thinking about what you want to do to your constitution, how you want to deal with particular issues, you should be thinking about what are these terms going to look like. Now, Jo made the point, there's not a lot of amendments you need to make to your constitution. It's effectively a handful, but what you should be trying to do, while balancing out the interest of your members, instead of the traditional members here, is try to give the board or a committee or someone the flexibility to decide what the instrument's going to look like. And in fact, you might find over time that certainly different mutuals will have different instruments, but the same mutual will have different types of instruments. There could be wholesale instruments, there can be widely held wholesale instruments, there can be retail instruments, there can be widely held retail instruments, there can be listed instruments, there can be unlisted instruments. We've spoken to a number of mutuals and to their boards, and I think they see a variety of different ways in which you can look at these as a product, but they're also conscious about what impact is it going to have on the traditional mutual structure. And to be honest, that's been a large part of the discussions with Treasury all the way since the Hammond report, was to try and understand how it will impact on the ordinary members. So I think, or the traditional members, I think we've decided to call them for this purpose. So people do need to think that through. But I don't think that people should be overly worried about, is this a massive influx of capital from a demanding series of investors? And at the same time, is it going to sort of override the traditional arrangements you've had with your more traditional members? But you will need to make that balance. And I think you need to think about that balance while determining what you want to put in your constitutions. But I must admit, as I say, I'm leaning very much towards trying to give you the flexibility. And the boards that we've spoken to have been interested in ensuring that they can issue in a broad sense and allow the board to make the decisions about what a particular instrument will look like. Part of that thinking, and as the slides go on, we'll just talk about two particular issues, which are voting and distributions. And the reason I've decided to talk about those is that seems to be where we're getting a lot of questions. People understand the idea of being able to raise capital, but they're interested, and I think their members are interested, in understanding what it means for voting and what it means for distributions. Does it lead to a profit type motive? Does it start to potentially change some of the things that Peter was talking about how mutuals think about themselves and how the members think about them? I don't think it has to, but it will require perhaps a slightly more sophisticated view of what the mutual is doing and why the funds are being raised. The who will buy MCIs and why is a really interesting question. There will be people who, and I think Peter was saying, I think it was the Canadian example, there are a lot of members of those mutuals who are buying the instrument as opposed to just being members. So I think there's a target audience there. You'll need to think about, do they want a simple instrument? Do they want liquidity? Are they investing because they want a genuine return? Are they investing having regard to wanting to make an ethical investment? People are thinking differently about how they invest in shares, potentially these days, to perhaps how they were in the past. Are you targeting wholesale investors? Are you targeting wholesale investors who are looking for a debt type instrument, those who are looking for a bit of more of an equity return, those who are looking for a different type of investment, which might be an MCI that's going to support a particular project that one of the mutuals wants to do, whether it's a digitisation project or whether it's actually just going and building something and progressing part of the business. You may well find that there are investors who want to almost target that particular type of investment. So I think there's a lot of flexibility about what you can do with the MCI structure. And I'd suggest, so we've spoken to a number of mutuals about what they could do, but I think you owe it to yourselves just to be a little bit adventurous in thinking about how you want to do these things. As I say, there are some markets which are obvious, and I think the mutual ADIs have got a great opportunity here. But for those who are just looking to raise capital more generally to do different things, to both sort of Greg and Peter's point, take the challenge up a little bit to do something a bit interesting. Think about why you want the money. Think about what you're going to do with it. Recognise there's a higher level of scrutiny that will come with it. If you have to do a prospectus, for example, that's going to be a different experience. Even doing a wholesale information memorandum will be different. But I know from some earlier discussions also from the investor point of view, we talk to investors about what type of products they'd like to invest in. They're setting up funds with different types of structures where they might like to invest in, as I say, more of an ethical investment, invest in particular areas, support particular industries. There's going to be an opportunity to do quite bespoke instruments. Equally, you'll probably get to a point where there's a relatively standard instrument, which again I think will be quite good for the industry. I suspect I know we'll hear from sort of ASIC later in the day. Having an instrument that people can genuinely understand because there's a few of them in the market and make a comparison to, well, this one does this, that one does that, am I happy with this, will be something which will help the market grow, I suspect. On voting, and just to reiterate, it is one vote per membership, not one vote per MCI. As amongst the MCIs, if they're having a meeting, they vote on a one-for-one basis. Questions we've already started to talk about with mutuals are, well, what type of voting rights do we want to give people? Should they be different to the traditional membership base of the mutual? Should they be voting on directors? Should there be categories of directors that are looking after MCI, not looking after MCIs, but say elected by the MCI holders? That might be a little tricky. It'd be interesting to see what people ultimately think about that. But how do you want them participating as part of the broader membership base of the mutual? Now, harking back to preference shares for a moment, they tend to have, and they do have, limited voting rights, but they're seen more as a debt instrument. These may not be seen as a debt instrument. These may be seen by people as making a genuine, equitable type investment and wanting to understand and be part of the mutual. Would they vote on otherwise amending the Constitution? Would they vote on a demutualisation? Putting aside the special procedure which has been enacted in legislation to allow these changes to be made, there will still be an opportunity to think about whether you would demutualise. How do you ensure in that circumstance that, or do you need to ensure in that circumstance that it's the traditional membership base that's making that decision, or is it the MCI holders as well, or are the MCI holders not involved? One piece of the legislation we haven't touched on yet, if you do demutualise, you've got to do something with the MCIs. And I think it's important, and the last slide mentions it a little bit, MCI holders are going to be, whether they're technically members or not, in a broad sense, they're members. They're interested parties, they're stakeholders in what you're doing. You're going to need to have regard to them, and you're going to need to balance their rights. So, for example, you can't demutualise and effectively sort of leave them in the cold. You can probably build that into the terms, and I think we've thought about ways of potentially having MCIs dealt with automatically if there was a demutualisation. On the other hand, to be honest, a lot of the mutuals we've spoken to aren't that keen to even foreshadow the potential of demutualisation, which I completely get. But these are the sort of issues you'll need to think about. These, once they're issued, are instruments which are not necessarily easy to amend, and you'll have two sets of stakeholders. You'll have traditional members if you're changing class rights, and you'll have the MCI holders themselves. So you can have different voting rights between them, and you should think about what voting rights you want to give. You might actually build some of those voting rights specifically into a constitution. There will be some level of negotiation with your members about what they want the powers in the constitution that allow the issue of MCIs to look like. And I suspect people that are doing it will probably want to have some ongoing involvement with their members before just hitting them with a notice of meeting. Some may not, but you just want to sort of make sure you've addressed some of those issues and taken account of what people might be concerned with. There's also an opportunity, as Jo said, the way the legislation is drafted, you vote in your capacity. An MCI member and a traditional member are different capacities. There's the opportunity for them to vote just purely in the ordinary course, or there's an opportunity for the terms to not allow them to vote in the ordinary course. So again, there's issues you'll need to think about as you design them. On distributions, it's important to remember that if people are making an investment in MCIs, they're making a financial investment. This is arguably, it might be a different type of financial investment, but this is not just becoming a member in the traditional sense. Whether this is a traditional member who wants to invest further to allow the mutual to grow, they're looking for some level of investment. They may not be looking for the highest rate of return or the most protection possible. They might be making a somewhat ethical investment decision, but they're still looking to understand what sort of return they might get. And in fairness, I think the boards of the mutuals need to understand what type of return they might be prepared to give. Dividends are non-cumulative, which is, sort of think about it as you have your shot, and if you don't get it that year, you don't get it caught up next year. But people will need to think about what these structures look like. Simplistically, they can be a fixed rate, and this sort of does hark back a bit to a preference share. Issue them for a face value of $100, pay 5%. Peter ran through some different effective interest rate returns on the examples he had. They can be a floating rate. This is not dissimilar to what you see on a lot of listed instruments, float above a bank bill rate, float above another reference rate. There might be a different type of reference rate the mutuals might seek to try and use. One we have thought about and spoken to a couple of clients about is, can it be performance-based? They're not profit-driven businesses in the same way as a traditional one, but they do potentially have the opportunity to earmark some of the revenue that they make effectively as a profit and pay it out as a distribution. Could you have it relate to a particular project? Say you want to go and build something. Digitisation is probably a bit difficult because you probably don't make an immediate return from that in quite the same way, but you could look at it as a type of loan. But if you want to build a new facility, if you want to do something different, invest in a different area, could you potentially link the returns of the MCI to that project? They are permanent capital, and I think it's important to remember they are a share. You can't redeem them. We had a discussion with the Treasury about this. We tried a couple of times to see whether we could get that flexibility in. Theory being they're not preference shares, they shouldn't be redeemable preference shares. There is the potential to buy them back though. And again, with clever drafting of the terms, you have an opportunity to say, well, after 5 years, we might be able to buy them back, or after 10 years, or after a project closes, we might be able to buy them back. So you've got some flex around how you can do those things. In fact, you've got to flex about a lot of things. Just need to think about what you want to do. Just finally, and we have touched on this a little bit, I think people do need to think about them as being a financial investment. I think there's been a tremendous amount of focus and goodwill from Treasury and from the industry to get to this point. And from the mutual perspective, I think there's a lot of interest in doing these things, but it is an opportunity for people to invest. So you're going to have to think about those investors as well. Access to surplus assets, this is going to be one of the things that has to be addressed, as Jo mentioned, in the Constitution. But think about it, I think Peter put it well, a lot of these businesses are custodian effectively of what's come before. On the other hand, if I've put $100 in as an investor, I might want to be able to at least get that $100 out, which is a normal sort of process for a preference share or a note. And again, as I say, think about treatment on demutualisation. Having, not so much in the demutualisation context, but in restructuring contexts, if you want to do those sort of things, or potentially do those things, it'd be nice to have addressed them in the terms. If you think of demutualisation is complicated just with members, imagine what it might be with various sets of MCIs on issue and a restructure in that context.